The cost of your groceries or petrol, rising business costs for entrepreneurs, even the asset allocation of an investor's portfolio. Inflation affects everyone. That's why the recent fears of rising inflation can have an impact on global stock markets. This happened despite most central banks, including the US Federal Reserve, calling the rising inflation numbers transitory or temporary.
The market is not fully convinced. If we look at the break-even inflation, it points to quite sustained inflationary pressure and expectation. So our view is near term, we see significant upside risk for inflation. And if we look at China, the PPI in April jumped to 6.8% year on year from deflation early this year. And also it may remain quite high. It may top 7% in the next few months. But despite of that, we think the inflationary pressure may ease toward the second half of the year, especially the end of the year.
However, some analysts caution that this is due in part to a base effect from last year, when numbers remained low due to the global lockdowns from the COVID-19 pandemic.
They are impacting and distorting the year-on-year figures. But we've also noticed that there's a shortage of goods in certain areas of the market. And this is because consumer demand has increased so quickly, largely on the back of all the stimulus and the reopening of certain economies. And at the same time, companies have not been able to increase output as fast. And so you're seeing a shortage of goods emerge across the supply chain. And this, as you know, is leading to higher inflation, which could persist for several months. Ultimately, though, we think that inflation will be transitory as consumption and production patterns normalize over the coming quarters.
Analysts are also concerned about the resurgence of COVID-19 cases in certain countries and the possibility of infections spreading as more countries ease restrictions.
If we see periodic rebound of the coronavirus case in both the advanced economies and the emerging market economies, the supply side will still be constrained. Another risk is from the US. If the fiscal stimulus become more sustained, even when the negative output gap is closed, then I think it will cause inflationary pressure, especially if the Federal Reserve is held captive to the fiscal policy to support a lower government bond yield, or even to start to monetize the fiscal deficit.
However, investors also need to keep in mind that inflation is just one indicator of economic performance that can impact stock markets.
Two other dominant drivers of markets will be the path of the recovery and also the trajectory of monetary policy, which will likely pass their respective peaks sometime this year. So against this backdrop, the market will begin to transition into a mid-market cycle where investors will increasingly focus on earnings growth rather than price to earnings multiple expansion. And therefore, history tells us that we can continue to expect positive returns in market, but this will be lower versus the initial post-pandemic recovery phase. And we can also expect a higher scope for volatility.
In other words, while a crash remains unlikely, investors can't expect the same level of returns as before. But in the meantime, they are advised to stay diversified.
One way to do this is to carefully include stocks in the financials, commodities, and energy sectors that enjoy attractive valuations and strong earnings profile, and also companies with strong pricing power, with resilient profit margins, especially when the cost of input increases. Treasury inflation-protected securities is an instrument that tends to benefit when inflation increases as well. Precious metals such as gold tend to perform well as a hedge against inflation as well, but we do think that it is a more speculative way to benefit from inflation.
Investors will also be keeping a close eye on the Fed for some clear messages on when they intend to raise interest rates.
If any central bank is forced to tighten interest rates more aggressively, This has an impact on the economy because it raises the cost of financing, right? So growth and consumer credit gets impacted, but also the stock market can get impacted as well because of the value and the discount rate used for the future value of cash flows. And so typically what happens is that those parts of the market that are more expensive, more overvalued, could easily get hit.
So does this mean that you'll need to pay more for your cup of coffee?
Being an open economy, Singapore is very sensitive to the price of imports. So if, for example, import prices were to rise dramatically through either raw materials or intermediary products which go into later stages of the manufacturing process, or even food prices, for example, which Singapore is very dependent on, then that could certainly lead to more elevated inflationary pressures. But at the present time, we don't think that this is a significant risk.